Hello and a warm welcome to Econoday Unplugged. It's Tuesday, the 16th of July, 2024. And on today's podcast, we have Terry Sheehan on US East Coast, Max Arto in British Columbia, Brian Jackson in Sydney, and I'm Jeremy Hawkins in London. Since our last edition, some of us have been lucky enough to have been on holiday, so it's high time we caught up with what's going on in the global economy and financial markets. It's fair to say that recent political events have added an extra layer of uncertainty to the outlook for both, but it's still mainly inflation that's shaping investor sentiment. So I guess it's a question of, are prices finally starting to behave themselves? Right, as usual then, let's kick off with Terry and the States. Terry, we've had declining inflation and rising unemployment rate for 3 months now. So, big question, are the economic conditions for a Fed rate cut at long last falling into place?
I think so. I don't think we'll see it as soon as the meeting at the end of this month, but I'm actually thinking that Chair Powell, when he visits the annual Jackson Hole Symposium sponsored by the Kansas City Fed, may give us a strong signal for a rate cut in September.
What do you think's really changed now versus, let's say, a month or a couple ago when all of a sudden people are thinking, are we even going to get a rate cut over the second half of the year?
Well, I think the main thing we can point to is the second quarter inflation data has come in showing the resumption of the disinflation trend after the first quarter looked like a big sideways move. And we see enough softening in the labor market without outright weakness in the labor market that it's the kind of thing that Fed policymakers have been saying they wanted to see. We're also seeing slightly less hawkish tone to public remarks from Fed officials. So altogether, I think things are moving in the direction of a rate cut.
All right, let me kind of play devil's advocate and sort of take it further. I mean, is it the case that we're now, well, people are pretty comfortable with the idea that we're going to get a soft landing? Or do you actually think some of the slowdown being implied by the economic figures have increased the chances we might actually be heading for a recession?
Well, we probably have increased the chances of a recession, but I would not say significantly at this point. We just saw we're going to see the latest Beige Book figures tomorrow, which should give us a better overall picture of the US economy. Mm-hmm. But if conditions have slowed a bit, they're still expansionary. Early forecasts for second quarter GDP put growth somewhere 1 to 1.5%, which is a little below the longer run expectation, but not much.
Okay, so I guess then the market, I think, is pretty well fully priced in now, a September cut. What might stop that happening?
I think the main thing would be if the current downward trend for inflation would be interrupted again, or if we saw a surge in the labor market for some reason, that might give policymakers some hesitation.
And do you think it's payrolls or the unemployment rate that investors should be looking at when it comes to the labour market?
Well, they should be looking at both, but I think it would take an acceleration in the upward movements of unemployment rate. Right now, we're at 4.1% as of the June employment report. If we suddenly go to 4.5%, that would be alarming. But these, 1 or 2/10 increments that we're seeing on a monthly basis are pretty normal for what you would see in an economy that was growing more slowly.
Okay, fair enough. Don't really want to talk too much about politics, but I guess we've got to say that the attempted assassination attempt on Donald Trump at the weekend has ensured that US politics remains sort of headline news all around the world. But more generally, do you think the upcoming election has significant implications for financial markets?
Wow.
I suppose really I'm coming from a line of, in terms of the potential for, changes in fiscal policy. I think it's interesting. I mean, we've seen the opinion polls suggest. Sorry, yeah.
I don't think it has a lot of implications, at least in the near term, for Fed policy. We actually aren't going to see a lot of turnover in the top Fed policymakers in the next year or two. So that part isn't really in question. But as far as fiscal policy goes, there is certainly a lot of sentiment out there on both sides of the aisle that we really do need to address the underlying fiscal situation in the U.S. and that I think there's going to be a lot more resistance to increasing the debt.
That's going to be fun, isn't it? Here we go again, so to speak. Okay, anything else from your side, Terry?
No, really, the big thing right now, I think, is that finally it looks like market expectations for a rate cut are not just wishful thinking.
It's taken a while, isn't it? Be interesting to see. Great. Okay, well, thank you very much, Terry. Max, Canada. Bank of Canada, as we know, cut interest rates in June, and I guess recent data pretty well helped to justify that move. More recently, we've had just a short while ago, we had what appeared to be, I think, a relatively soft inflation report. Relatively weak business survey from the Bank of Canada yesterday. So what are the chances of another cut in interest rates from the central bank next week?
Well, until seeing a mix of those indicators you just mentioned, I thought they could still be cautious and wait till September. But I think the odds are higher now for go next week. But I would be still careful. I wouldn't say it's a done deal because Governor Buckland last month was still saying he's looking at both upside and downside risks.
Right. So what's your bet? Yes or no? In fact, and what I suppose, what's altering the balance? What's tipping it one way and what's tipping it the other way?
I think bank sent a message yesterday in the surveys, both businesses and consumers. Interesting point is not just the latest inflation figures. They didn't see the June figures anyway. The inflation expectations, the way they describe, for example, for businesses, firms' expectations inflation fell in June, and now in the Bank of Canada's inflation control range, which is between 1 and 3. Actually, the Business Outlook survey, which is a quarterly survey that we saw yesterday, firms' expectations for inflation over the next 2 years are roughly unchanged, so still at 3%. But there's a monthly survey to complement. It's called Business Leaders Pulse. That actually show that inflation over 1 year ahead, that's a shorter term, they described it fell sharply in June to 2.9, after rising to 3.3 in April from 3.1 in March. So that tells you something, because they always said one of the key things they're looking at is underlying inflation, inflation outlook. So, and then consumer inflation expectations are also easing. So that tells you, combined with an uptick in unemployment rate, and then today's release for June CPI, not a huge decline, because most of it is coming from lower gasoline prices. So I think among themselves, the policymakers at the Bank of Canada, they're still debating among themselves. And then I think before coming to consensus, there will be pros and cons.
Okay, fair enough. Right. Okay, let's move on then to Japan.
Yeah.
Bank of Japan maintains that normalizing monetary policy will need a virtuous growth cycle. So I was just trying to find the quote. And they say that it will need a virtuous growth cycle whereby solid wage hikes are accompanied by durable inflation and household consumption. So I guess the question's got to be, are we there yet?
It's a tough situation, the Bank of Japan has been in, because in communications, they cannot say, well, I know you guys have still high food prices and utilities are back up again, But we think underlying inflation is still too low, so we have to continue a general overall accommodative stance. But they can't really say that politically because inflation and we can. The story has changed. They used to look for hate higher yen in the past, but now everybody's saying, why don't you just raise rates to help ease the pressure on the yen selling? But as you can see, by law, the Bank of Japan can only that the mandate is to seek price stability, and they have no authority over currency stability. And if you can remember, the G7 accord for years is to not to use monetary policy to influence foreign exchange or any other policy measures to influence forex rates. So the only thing Japan can do to ease the pain of high import costs aggravated by the weak yen is for the MOF to intervene. And I'm just going back to the question of wages and how we find the progress. It is in the CPI, services prices not doing well. In what I mean is not rising as fast as the Bank of Japan wants. So for now, I don't think we have a meaningful rise in underlying inflation, which is key to BOJ's judgment that services are rising, which means wages are rising substantially and sustainably in a way that economy will keep growing.
Okay.
And yeah.
Can I ask you, in terms of this, I think that their core rate is what is mainly excluding fresh food, isn't it? And I think we'll get an update on the CPI. It's Thursday this week, remember rightly. Now, that, I guess, is pretty well guaranteed it's going to come in above 2% again. And if it is, that would be, was it 27th straight month of being above target? So, I mean,
that's the problem. We see.
I was going to say, how many months does it have to be above target before they finally decide, well, look, it's above target. We need to do something about it.
That's not what BOJ is talking about. Underlying inflation measure, they say it's a comprehensive judgment, but it's still at about 1.5, not even 2. And the governor did say in May that all the measures, the trim mean and the anecdotal evidence, that they still show that it's below, all the measures are below 2%. So that means that's coming from really weak services, basically wages. So even if we see this week, probably total CPI up to 2.9 from 2.8, ex-fresh food up to 2.7, 2.5, that's still counting in, for example, energy. And excluding both fresh food and energy, you'll be up to 2.2 probably, but it is not what BOJ has been implying. It's not a total underlying inflation measure that they're looking at. So I know there's a gap between what general public is seeing and what BOJ is thinking.
Okay, fair enough. So I assume you're expecting no change in interest rates at the end of this month?
I think it's safe to say so. We have to see monthly wages data from the labor ministry. We haven't really seen hugely widespread wage hikes throughout the system. We have to see still June, July figure. The July preliminary will be out early September in time for the September meeting, which is going to be late in the month. So I don't think they'll move this month.
Okay. But there has been a lot of talk, as I understand it, about change to bond purchases being announced at
Right.
this meeting. How bigger do you think that's going to be? And I mean, again, you've got to weigh up, I suppose, the implications, what it might mean for perhaps higher borrowing costs, and ultimately, what it might mean for increased debt service. But what do you think they actually might do in terms of reducing or tapering the size of the current bond purchase program?
It's not going to be a kind of a Fed type tapering or quantitative tightening. They're still talking about the amount of JGBs they buy, so not selling it's the governor has said that it's going to be fairly not drastic, substantial. So yeah, new purchases will be down, and but looking at the total balance of the holdings, and also still super low interest rates, I think conditions will remain accommodative for now, until they actually become confident that they can hit stable 2% in the future, maybe in 2 years from now.
Okay. My last question again is just sticking with the policy side of it. So as you say, it's still quantitative easing as opposed to quantitative tightening, but from a market perspective, if they do reduce the purchases, it's going to be less quantitative easing, come the end of the month than it is at the moment. So does the Bank of Japan see the adjustment to its balance sheet as being sort of completely separate from what it might be doing with interest rates? Are we in a world in which they simply need to get the balance sheet down, or is it a means they can see of actually starting the tightening process for the overall monetary picture?
I think what they're trying to do is to prepare for an eventual total exit, and they know that it's going to be really hard cutting and selling without hurting the financial markets and overall confidence. So I think they're trying to make it easier as they really start to tighten. And also, as you mentioned, on the fiscal side, they don't want to have a huge impact all at once.
Yeah, I'll tell you what, there's been some interesting developments, I think, in some of these debt markets as we start getting some of these changes in policies coming through. Okay, anything else from you, Max, on Japan?
Nothing so far.
Okay, brilliant. In which case, thanks, Max. And let's, with that, move across to Brian. And then, still lots of interest and I guess uncertainty over where China's headed. Inflation is still barely positive, and if anything, house price declines seem to be accelerating. So are deflationary pressures actually easing out there?
No, there's no evidence of it, that's for sure. As you say, the inflation numbers were very weak again a week or so ago. The headline CPI is around 0.2% year on year. PPI numbers are very weak. So really not much evidence of, price pressures anywhere in the Chinese economy. And as you mentioned, house price deflation has gotten worse, quite markedly so over the last few months. We've had it sort of in negative territory for quite some time now, but it started to stabilize towards the end of last year and the start of this year. But just in the last 4 or 5 months, it's turned the other way, and it's getting more and more pronounced, the deflation in Chinese residential house prices.
And do you think that's just a reflection of what appears to be ongoing weakness of domestic demand? I noticed that the second quarter GDP numbers a little bit disappointing. June retail sales undershot expectations as well. So is it just a case they can't really get domestic demand in China going?
Yeah, well, I guess they're reinforcing each other. The weakness in the property market is weighing on consumer sentiment and consumer spending, and and the lack of a strong consumer is also obviously impacting the property market sentiment and performance. We did see a few sort of measures put in place, earlier in the year to try and restore a bit of vigor to the property market, but it just hasn't worked. And it's sort of hampered by the fact that there's not a lot of fiscal room for them to move on with
Right.
The high levels of government debt, particularly in the regional and provincial governments. So yeah, they've got a bit of a dilemma, just how to respond to this weakness in the property market. At least we did get some slightly better news on other parts of the economy. The manufacturing sector is relatively solid. The industrial production numbers sort of growing around 5 or 6% year on year, and also the one of the PMI surveys for the manufacturing sector. There's an official survey and a non-official survey, and that non-official survey has shown some improvement in recent months. So we at least have sort of slightly less gloomy performance in other parts of the economy. But yeah, I think this property market is definitely a concern.
And I guess a lot of the growth coming out of manufacturing, the production there is actually being exported, because exports seem to be holding up pretty well.
Yeah, correct. So the trade numbers again for the most recent trade numbers show reasonably strong growth in exports, though the Chinese authorities are highlighting that it could be better. They're sort of saying that if it were not for some of the other problems going on in the world, they'd probably have more support from external demand and the economy going better. So they have sort of highlighted that as one of the reasons why things aren't going as well as they'd like to. But relatively speaking, both the manufacturing sector and exports are doing a little bit better.
How concerned are you about credit growth? I saw a report the other day. I remember rightly, I think bank loan growth was up about 8.3% on the year, and that was the slowest growth we've seen since going back to, I think it's 2003. Is that something which is going to worry the central bank, or are they not particularly concerned about that?
Oh, I think that's just indicative of the the other things that we've been talking about, just the weakness in domestic demand, the weakness in the property market. So there's just not really a lot of impetus for credit growth at the moment. So we are starting to see some talk about maybe they need to make some further adjustments to policy settings with the loan prime rate or bank reserve requirements to try and get that up. To get that moving again a little bit quicker. It was interesting in recent months when they put out their raft of monthly economic data. They'll have a little blurb where they talk about how things are going and what that means for policy. And in recent months they've been talking about how they don't need to adjust policy settings because they've already made adjustments, and that they're hoping that the impact of that adjustment will be front-loaded. So they've sort of used this phrase front-loaded the last couple of months to indicate that we've already put the measures in place and we just need to see them work. They removed that reference though this week in the latest set of monthly numbers. They're not talking about all these things that we've done and it's going to be front-loaded. So that could perhaps be an indication that they think they do need to do a little bit more. So we'll see.
So presumably they'd be really happy if the Fed were to come out and cut interest rates sooner rather than later.
Yeah, I mean they obviously would like any help they could get from external demand and other central banks.
Well, I think particularly with regards to the exchange rate.
They already have reduced that loan prime rate reasonably aggressively over the last 3 or 4 years.
Right.
It's at sort of historic low levels. There's still room for they could, I think it's 3.45%, so they could definitely cut it again, and I think there is talk that we might see that in the next week or so when it comes out. But and as we said, with inflation so low, they do have a bit of leeway that way as well. But sure, any support they can get from other major central banks I think would be welcomed.
All right. Okay. Let's move across to your immediate part of the world and Australia. For what I've seen, it looks as if, people are even talking about the possibility of the RBA having to hike interest rates again because inflation simply isn't behaving itself. What do you think?
That is 100% true. That's the big issue for the Reserve Bank of Australia right now. They have forecasts for inflation to get down to their target range, sometime in over the medium term horizon, and they've sort of been holding policy rates unchanged since I think it was November. hoping that that's going to happen. And unfortunately, the monthly CPI numbers aren't cooperating. It's ticked higher the last 2 months, particularly the one we just had that went up by more than people were expecting, and real concern that this path of disinflation, which they had been hoping to see, is not happening at the pace that they would like. It was interesting. The monthly inflation number, was largely sort of driven by energy prices. So fuel and electricity prices were up quite sharply, and the electricity price, I think it was 6.5% year on year, but that was would have been much higher were not for the impact of some pretty big government rebates. That would have been 14.5% year on year if it weren't for those rebates suppressing electricity prices to some extent. So real concerns about the near-term inflation outlook, and I think that was evident in the comments by Governor Michelle Bullock after the last policy meeting a few weeks ago.
Okay, so inflation at the moment going the wrong way. What's happening to the labour market? Are there any signs there that it's cooling fast enough that perhaps they can sort of ride out the current storm?
The labour market's pretty solid, and I think that's contributing to their concerns about the inflation outlook. There's not really any evidence that the current level of policy rates is really slowing down labour demand or making conditions much weaker in the labour market. If anything, it's still relatively tight. On the margin, perhaps not as tight as what it was, but I don't think they're going to get a big fall in employment or a big rise in sort of the unemployment rate. It's going to keep on, I think, contributing to this, to the focus on inflation going forward. And the activity numbers are also bouncing around a little bit. We saw retail sales a couple of weeks ago a bit higher than I expected, because people were saying the end of financial year sales were a bit earlier than they normally were. We seem to have a lot of changes to the normal seasonal pattern of things recently, and that was another one there. So they're getting a little bit of mixed signals from some of the activity data as well. But I think overwhelmingly, the message is clear that inflation is the number one concern. And so we have the RBA saying, look, we're on a narrow path to actually make this work, and the path is getting narrower. So if anything, the intention is moving to the potential that they will have to raise rates again. It's notable that at the last meeting, or the last two meetings, a rate hike was considered. The minutes show that they weren't considering a rate cut at all. The alternative to what they decided to do to leave rates on hold were rate hikes both times, and so that's clearly right at the front of their considerations at the moment.
Right. Next meeting, 6th of August, isn't it? Remember rightly?
That's right. Yeah. It was 6th or 8th. Yeah, early August. And before then, we will get the quarterly CPI number as well. So that's interesting. They'll have a chance to have a look at some of the broader. The monthly numbers don't capture the whole sort of story. The quarterly number is a bit more thorough and comprehensive. So they'll be using that to update their inflation forecasts and to hopefully get a little bit more confidence that things are tracking in the right direction. But it is notable that they will have that CPI number in front of them, the quarterly CPI number, the next time that they have their policy meeting in early August.
Okay, interesting stuff. Let's round off your side with India then. And again, just sticking with this sort of typically, strong inflation theme. June CPI up at over 5% again, so above the midpoint of the RBI's target range. Again, has this got any implication for a possible hike out there?
I think it keeps it on the table, but my impression is at the moment the RBI is reasonably comfortable with the situation. They're quite fortunate in that they're not really concerned about the impact of policy on the activity side of things. The activity numbers are pretty solid. If you look at GDP, industrial production, the PMI surveys, things are going at a pretty robust pace in the Indian economy. So they don't really need to be too worried about that at the moment. And so the focus definitely is on inflation. But that said, as is typically the case with India, the CPI basket there is very heavily impacted by food prices, and so they obviously bump around quite a bit. And I think some of that upward pressure that we have seen on the headline rate in the last couple of months has really just been driven by food prices, and the RBI does tend to, discount that to some extent and to look through the impact of food prices on headline CPI numbers. So, they might be able to sort of keep policy rates on hold for the near term, but definitely the focus is still very much on the inflation outlook and making sure that that food price inflation doesn't pass through to inflation expectations and the rest of the economy.
Interesting, at a time when so much speculation about when interest rates are coming down here, there and everywhere, there's still certainly parts of the world where rates may be going completely the other direction. Okay, anything else from your part, Brian?
No, I don't think so. Obviously, lots of external news in Europe and North America that's causing a lot of interest in my part of the world. But I think, as you said, we are definitely focused on also just where we are at the cycle, and inflation is still very much front and center in India and Australia and other parts of Asia, definitely.
Brilliant. Okay, thanks a lot for that, Brian. Speak to you next time. Okay, let's get across to Europe then. As Brian mentioned, well, politics has certainly been a major focus in recent weeks over here, with huge anti-government swings against the Conservatives in the UK and Emmanuel Macron centrists in France. However, neither event seems to have unduly ruffled financial markets, although it may well be that investors start paying more attention to government borrowing of coming months and quarters. For the Eurozone, recent real economic data have shown no major surprises, though if anything, the overall bias has probably been on the downside. Manufacturing is certainly still struggling. Industrial production in May saw its lowest level since October 2020, with Germany, where earlier tentative signs of recovery have faded out, really struggling. Certainly retail sales have done little more than flatline so far during the course of the year. So certainly, by and large, we can say that the real economy could do with an interest rate cut. However, and again, we're back to inflation. Core inflation is proving increasingly sticky. And almost certainly, I think that rules out a second successive ECB cut when we get to the announcement on Thursday. Inflation in services is still up around 4.1%, and it's been close to that level since back November of 2023. At the same time, the labour market is still very tight. The May data, the most recent we have, put the unemployment rate at 6.4%, which may be higher than some other countries around the world, but it's also a record low. Indeed, it's not clear if unit labour cost growth, which is one of the key elements that the ECB looks at with regard to where inflation might be heading. It's not clear if that's slowing as quickly as what the June ECB forecast suggested. So pull all that little lot together, and it suggests that I guess most general council members on the ECB, they're going to want to see some fresh reassurance that inflation is still on track to meet its target on a sustainable basis. And that's almost certainly going to require an updated set of economic forecasts. So the next round will be available at the 12th of September's policy announcement. So expect no cut in interest rates on Thursday. And indeed, there may even be no move in September if the inflation data in the interim surprise on the upside. In the UK, well, we have a new Labour government as of last week. Days gone by, that would likely have rattled financial markets, but a sizable Labour victory was already priced in. Indeed, it had been priced in for several months now. Importantly, too, Labour policy is currently seen as much more business friendly than in the past. And crucially, too, the incoming government is committed to retaining the independence of both the Bank of England and the Office for Budget Responsibility, so-called OBR. It aims to balance the current budget, so increases in spending had to be matched by higher taxes, although investment spending can be financed by increased borrowing. Time will tell on that front, but at least for the time being anyway, financial markets seem to be happy that we have a stable government with a large majority, and certainly they're giving the new government the benefit of the doubt. So we got a strong pound at the moment, and certainly a general optimism, I think, or increased optimism about where the UK economy might be headed. And that's, I guess, kind of supported in the recent data. First quarter GDP growth was revised up to 0.7%. And what we've got so far, it looks as if the second quarter is going to hold up rather better than most people expected, including the Bank of England. The average April-May GDP levels running about 0.6% above their first quarter mean. So looks as if, by and large, first half of this year, growth in the UK is going to outperform expectations. Inflation, well, we'll get an update on inflation number for June tomorrow, and indeed we'll get new labour market report on Thursday, and that's going to be key to how the MPC vote come the next meeting on the 1st of August. Currently, inflation stands at 2%, so we're finally back on target level, but note that the core rate is still up at 3.5%, and services, which is a big problem across Europe and indeed the States at the moment, that's still running at some 5.7%, so almost 3 times the target rate. So on the whole, it looks at this stage, I think, probably a little bit premature to assume that we will get rates coming down again as soon as the beginning of August. But certainly once we get to the September meeting, that'll be on the 19th. It's certainly possible, I think, we could see another cut in interest rates there. But again, just to reiterate, it really does come down to how these inflation numbers perform. Inflation across most of Europe has come down relatively quickly over the course of the last, almost a year or so now, I guess. But it really has become the case now that further improvements on the disinflationary trail, they're becoming harder and harder to come by. Okay, then. Well, I guess that's pretty well it for today then. Politics, well, that may be hard for investors to ignore over coming weeks, but ultimately it's still going to be the economic data in general and indeed inflation in particular that determines what actually happens in financial markets. So as I always say, make sure you keep up to date with all the key economic statistics and indeed other market moving events in Econoday's global economic calendar. On behalf of Terry, Bra, Max and me, thanks as always for listening. We hope to see you again next time. Bye for now.